Good day, everybody. Today, I want to show you how you use your hard-earned money to make more money for yourself. So you don't need to work so hard offshore anymore. So you need to start from young. So today, I would like to show you guys how I actually evaluate a company before we invest on a company that we want to buy. So today, I look at the Alibaba Group. Okay, so this is the evaluation that I've done during March. I evaluate based on 4 criteria, which is the profitability, cash flow, the company, the efficiency of the company, and also the conservative, meaning a lot of money or just a little bit of money. Okay, so I start from beginning, and you can see this is Alibaba Group Holding, which is I've done it on the 3rd of March. So this is the income statement where I retrieve it from the annual statement. To look through how the company actually is profitable, okay, you can go to the income statement, right, and you can see the revenue and the net income, which is already adjusted. Okay, first of all, this is the criteria, and just make sure that the revenue is growing. Okay, must be yes, and then the net income, is it increasing? Yes. So these are the criteria that you need to make sure yes, it's not no, right? So how to look at it is, if you look at the revenue of Alibaba since 2016 all the way to end of December, all right, Q3 to 2020, you can see the revenue is growing, blum, okay, which is good. So this is the first criteria, is say yes. So you know that the company have very good revenue of their business. So then you see the net income. Of course, the net income need to be growing as well. Okay, so you can see from here, it's growing. So that's the 2 criteria we made. So it's good. Okay, and then this is the diluted earning per share, and it should be growing and consistent, and also must be yes of this criteria. So this is good. So now we come to inflow of cash flow ratio, right? Then if you look at cash from operation, and you can see it's growing. So the criteria is you need to be growing. Okay, the OCF need to be growing, must be yes. So you can see the cash operation is growing. So you can see there's a capex over here, and after that you can see all the deduction of that. You can get the free cash flow. Cash flow of Alibaba is very strong. There's a lot, and it's growing. Okay, so now we meet all the criteria. Yes. So this is the second criteria that is say yes to go, right? So the third criteria is whether the company is efficient or not, right? So you can see the return of equity, ROE, it must be more than 15%. If it's less than 15%, then it's not so good, right? If it's more than 50%, then it's a good company, which is everything is so efficient. 2016 24.7, which is good, and then after that reduce, but anyway, it's still within the range of 15%. So it's acceptable. So this is the third criteria, is passed, right? And then conservative, and we want to see whether the debt or equity, which is less than 0.5 or 50%. If yes, then this company is good. The debt or equity is more than 1.5 or 150%, so better don't invest, because the company owe a lot of money. I don't think it can sustain, right? Then we look at the total debt to equity ratio. Okay, so you can see it's only 0.2, and as time goes by, it becomes 0.13, meaning to say their debt is getting lesser and lesser. It's only 0.1. So yes. So this company is yes, it's a good company. So final checklist. Okay, sorry, this is top blur, but anyway, this is I forget to delete it. This is Alibaba, right? So we have 4 checks, 4 criteria meet, which is all good, and it's good to go to buy, right? This company do not give any dividend because this is a growth stocks. Okay, they grow every year. As you can see, I show you the charts of Baba. You can see the charts from 2015, right, all the way up, going, then go down again, go up, and you can see this is falling a little bit because of the regulatory issue in China recently, that Alibaba get fined 2.8 billion. Anyway, this is just a temporary event, so shouldn't be worried much about that. Okay, and for now you must know how to look at the intrinsic price. Fast growth company, so we use this formula to justify the intrinsic value of the company. Okay, this is 5 years CAGR. All right, this is the percentage, and diluted EPS, the PEG is for Alibaba is 40.04. Okay, so we get it from this area. For me, I would like to choose the latest one, not this is not very accurate, so I choose 40.04 for Alibaba, and diluted EPS I choose 5.83. Okay, so then this is the formula that we use to calculate the intrinsic price. So the company right now during March is worth $233, and you can see current stock price of Alibaba is somewhere 200 235. Like yesterday is 235, 36. Okay, so that is still consider very good price to buy. And you know, when you buy this type of company, you can sleep well. Of course, there's a risk. Okay, there's a risk of investment or investing company, but for Alibaba, as you know, Jack Ma, so normally we say that if we can't beat them, you join them. Okay, so that's why we join them. I love his stock, so I put some money inside his stock. Okay, so you don't, this is not a scheme pakaya, when you buy, then the next day will become rich. No, but this is something that you invest your $100, and in next year probably you gain like 20%. So this is like $120. If you during that time you need to use that money, you can always cash it out, and at least you make the 20% instead of you put it in your bank. In Malaysia right now, what's that called, the fixed deposit is only 1.5% if you put it at monthly auto renew. Personally, I would like to put my money in stock market. So for Alibaba, the intrinsic price during March is about 233, and some experts have forecasted their intrinsic price in 2 years close to $350. So which is from now is 235. It may in 2 years time, in 1 year time, may go up to $300 or 350. So that is the gain that you can see that this company is doing very well. Right, you can see the chart, from 2015 all the way. If you draw a straight line, you can see the growth is like more than 20% each year. Okay, so this is how I evaluate the company, and if you want to see more, I can show you Top Glove. Right, people love Top Glove before. Okay, and a lot of people lose a lot of money also last year. Okay, during the pandemic, so a lot of people keep buying and didn't know what is the intrinsic price of the company. Of course, after the now we're still in the pandemic, whether the Top Glove still suitable to buy or not, then we have to look back into the fundamental of the company, whether they are making profit or not, whether the company is operating efficiently, and then whether they owe a lot of money or not, and whether they have good revenue or not. This is very important. Presently he's good, then you still can buy. Of course, you need to buy at the fair price. The fair price is intrinsic price that we call as the fair price. If the price is undervalued, then you still can buy. Why not? Because the company is doing very well of now. Of course, you need to evaluate this company every 3 months. You don't just put it there and then hope for miracle after 10 years you'll be rich. So you don't do that. So you evaluate the company every 3 months. Then you know whether this company is doing well or not. So this is Top Glove, and you can see the income statement. See, very good. Pam 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 pam. Revenue. Of course, it's because of pandemic. We go even higher. So the net income, blah blah blah. So getting growing, and the diluted EPS also growing. Okay. So this is a yes. You can see the cash flow, going up so fast because of pandemic as well. Of course, after pandemic, we look again, see whether they are doing well or not. If not, then we sell the share. Right. See the free cash flow going like crazy. So there's a lot of money within the company. So it's good. And efficiency. If you look at the efficiency of the company, look at that, 15.7 all the way, 14, 10, 30, 79. Of course, this figure is because of pandemic, and it becomes like super efficient because a lot of people buying the club. And then conservative, look at that. As I said, this is the criteria, 0.5, below 0.5. Look at the debt, 0.065 times. So there's very little. So this company is 4 ticks for me. Good to buy. Good thing about this company, again, they give dividend as well. So it's a growth company and they give dividend. So it's a win-win. So you very hard to find this type of company where they grow very well and they also give dividend people like us who invest. Alright. Okay, so how we calculate the intrinsic price for this, because this is considered the dividend share as well. So this is the share price amount is 4.8 and dividend per share is 0.283. So this is dividend yield. So this is 5.9. It's a good to go. And of course, during March, I received some dividend from Top Glove as well. Right. That time, June, the current stock price was 4.8 as well. So meaning it's still at the fair value, right? So this company ever will up to like $9 and now they get, so that's very high already. That is too much in the overvalue. That's the time you don't buy, because if the stock is so high, I'm meaning to say that majority of the investor that do not know how to evaluate the company, they will just follow because they say, oh, this share is good, it's going up, let's buy. So when the thing just turn over and drop all the way down to 4.8, that's mean you lose almost 50% of your money. Okay, so you must know, first of all, you must know how to evaluate the company, and it's a very good fundamental. Then the second thing, you must know fair price of the company, the intrinsic price of the company. The moment you know these figure, then you know that you can buy the stock and you can sleep very well for the next 3 months. So every 3 months you evaluate stock again. Dividend stocks, you need to have like more than 5%, then it's good. Use your hard-earned money offshore. Some buying mutual fund, put the money inside the fixed deposit. Some of them even didn't do anything with the money, just leave it there. For sure, if you leave your money in the bank, for sure you will lose the money every year because of the inflation. Okay, so this is how we evaluate the company. All right, thank you for watching.